Welcome to this deep dive. Today, we are plunging into a really detailed business quality analysis of Netflix, ticker NFLX.
Yeah, and this isn't just scratching the surface. We're working directly from this comprehensive analysis document that you, our listener, actually shared with us.
That's right, which is great because we've got this whole stack of insights, specific data points, different perspectives, all straight from your source material. So our mission today is, well, to unpack all of this together. We want to pull out the most important nuggets, the key insights, and give you a kind of shortcut to getting really well informed on Netflix's business.
Yeah, covering its strengths, the financials, the risks.
Yeah.
We're digging into the surprising facts from the source.
Exactly. Think of us as, navigating this with you, finding those crucial pieces and trying to connect the dots.
Okay,
let's unpack this then. Where should we start? Maybe the absolute core. How does this analysis describe the fundamental Netflix business model?
It's interesting. The analysis really emphasizes how simple it is at its heart, but also how powerful. It's direct to consumer, right? Subscription-based.
Okay.
You pay a monthly fee, you get access to all this content on demand. And that predictable monthly revenue, that's the main engine.
And simple doesn't mean weak, apparently. Why does the analysis say this model has held up so well?
Well, because it taps into something really fundamental, the desire for stories, for entertainment, escapism.
Yeah.
But delivered super conveniently.
Right, the whole on-demand shift.
Exactly. It rode that massive wave, that structural shift from linear TV appointment viewing to watching what you want when you want. And the analysis seems pretty confident this core model is so aligned with, well, how people behave now and where tech is going, that it's likely to stay relevant for, decades.
But it hasn't stayed perfectly still, has it? The analysis points to some pretty significant evolution.
Oh, absolutely. The core subscriptions, yes, but they've layered things on. Tiered pricing, for one.
Different quality levels, number of screens.
Right. And, crucially, the introduction of that ad-supported option.
That ad tier feels like a really big deal in the analysis, more than just a pricing option.
It was huge. A major point in this document. Introducing it back in 2022 created a whole second, really powerful revenue stream from advertising.
And they're serious about it.
Seems so. The analysis says they're scaling it aggressively, building their own ad tech in-house, and aiming, get this, to double ad revenue in 2025 alone.
Wow, doubling it. That's ambitious.
Shows commitment, right?
Definitely. Are there other, maybe smaller revenue streams mentioned?
Yeah, the analysis touches on some tertiary ones, like sometimes licensing their hit original shows to other platforms.
Oh, interesting.
Merchandising, too, based on big IPs like Stranger Things. And even getting into ticketed live events, sort of leveraging the content again.
So pulling all those streams together, subscriptions, ads, these other bits, how does the analysis say they actually turn a profit?
Well, that's basically when all that incoming revenue exceeds their pretty substantial operating costs.
The content being the big one.
By far. Billions spent creating originals, licensing shows, movies. Then you've got the tech platform costs, development, marketing, keeping the whole thing running and growing.
So when revenue beats those costs, they're in the black.
That's the basic equation, yeah.
Oh, okay. This talk about evolution ties nicely into what the analysis calls a master stroke in adaptability. What was that?
That's referring to the big pivot they pulled off in 2022, maybe spilling into 2023.
No.
Doing two things at once, basically.
Which were?
Cracking down on password sharing and rolling out the ad-supported tier simultaneously.
Right, I remember that. It felt a bit defensive at the time, like growth was slowing. What does the analysis say the impact actually was?
Well, it worked. It successfully re-accelerated revenue growth.
Yeah.
They managed to effectively monetize something like over 100 million viewers.
Wow.
People who were already watching already engaged through shared accounts, but weren't actually paying customers before.
So it wasn't just defense.
No, the analysis really highlights this as proof that management could adapt when they saw market saturation signs. They didn't just hit a wall. They found a way to effectively expand their total addressable market, their TAM.
Clever. So defense turned into offense.
Exactly. The ad tier dramatically lowers the price point.
Yeah.
Right? Makes it accessible for a whole segment of consumers who might be more price sensitive.
Brings more people in.
Yeah, expands the potential customer base, but also it probably helps reduce churn among existing users, maybe looking for a cheaper way to stay. It just widens the funnel, as the analysis puts it.
Okay, and here's where the analysis got really interesting for me. It wasn't just about getting more users with the ad tier, but about the profitability of that new revenue.
Yes, this is a critical insight in the document. That ad revenue is apparently quite high margin.
Why is that?
Because it leverages the massive content library they've already paid for. They're selling ad slots against shows and movies that are already produced, already sitting there.
Gotcha. They don't need new content spend for those ad dollars proportionally.
Right. And the source points to the size of the prize the U.S. TV advertising market is, like nearly $70 billion. Netflix is now tapping directly into that.
So revenue growth without the same level of content cost increase.
Exactly. It's a new profitable engine.
Yeah.
And one that, competitors who are still bleeding cash on their streaming services find really hard to replicate at Netflix's scale.
And they're adding other things now, too, like gaming and live events. The WWE Raw deal is mentioned. How does the analysis see those fitting in?
Those are framed more as ways to increase user engagement, make the service stickier.
Keep people around longer.
Yeah. The more ways people interact, watching shows, playing games, tuning into live stuff, the more embedded Netflix becomes in their routine. It reinforces the whole economic model, strengthens the value prop, and maybe, down the line, justifies future price adjustments.
Okay, so they've built this evolving business. Let's talk about protecting it. The analysis uses the term competitive fortress, an economic moat. How is that moat defined here?
The primary moat is described as this powerful, kind of self-reinforcing flywheel. It's driven by two main things: intangible assets and a scale-driven network effect.
Intangible assets?
Yeah.
Like the brand?
Exactly. The Netflix brand itself is huge, globally recognized. It's become a verb, right? Let's Netflix something.
True.
And that brand strength is backed by their enormous and increasingly exclusive content library. The analysis mentions over $100 billion in cumulative content spend over the years.
Wow.
Thousands of licensed titles, sure, but the real differentiators are those exclusive Netflix originals: Stranger Things, The Crown, Squid Game. You can only get them on Netflix.
Okay, that makes sense. What about the scale-driven network effect? The analysis says it's not a traditional network effect, which caught my attention.
Right. It's not like Facebook, where more users make it directly better for other users. It's more of a two-sided scale advantage.
How does that work?
It comes from having nearly 300 million global paid subscribers. That sheer scale is the key.
And how does that scale create this virtuous cycle, this flywheel effect?
Well, because they have this massive base, they can spread their huge annual content budget, or in the analysis say, over $17 billion a year.
Yeah, something like that.
They spread that cost over a much larger revenue base than any competitor. This scale lets them invest more in content than others can really afford.
Which attracts more subscribers.
Right, which attracts and keeps more subscribers, which generates more revenue, which then justifies even bigger content investments, making the service even more valuable.
Which attracts more subs. I see the cycle.
This keeps spinning faster and faster. The analysis calls this the core engine of their competitive advantage.
Okay, so that's the theory of the moat. But does the analysis show proof it's actually working in the real world?
Yes, and the most compelling proof highlighted is customer retention. The churn rate data.
Low churn despite all the competition.
Exactly. The analysis shows that even with this crowded market, Disney, WBD, Amazon, Apple, you name it, and even though Netflix has raised prices multiple times, they consistently have the lowest churn rate in the whole streaming industry.
Are there specific numbers mentioned? That always helps.
Yeah. The analysis cites data from Antenna for September 2024 showing Netflix's net churn was just 1.0%.
1%? How does that compare?
Well, the average for other premium SVOD services was 3.1%. So yeah, a massive difference.
3 times lower, roughly.
And this isn't just a U.S. thing. This industry-leading low churn holds up globally. EMEA, Latin America, APAC.
Okay, so this tiny 1% churn rate, what does that tell us about the moat actually functioning?
It's pretty direct quantitative evidence, right?
Yeah.
It shows that hundreds of millions of people worldwide see enough value in Netflix's content, its interface, its whole package, that it outweighs the cost compared to alternatives.
Even when prices go up.
Right. The analysis notes they have this pricing power. They can periodically raise prices without a mass exodus. That's clear proof of a durable advantage. They translate that leadership into higher revenue and profits.
So people might complain.
They might grumble. Yeah, the analysis says as much. But ultimately, they value the service enough that they don't cancel.
And the analysis doesn't stop there. It suggests the moat isn't just stable, it's actually widening. What's the evidence for that claim?
It points to what's happening in the streaming wars right now. This phase of economic rationalization.
Meaning?
meaning many of Netflix's big legacy media competitors are still losing a lot of money on their streaming services, billions in some cases, whereas Netflix is highly profitable, generating billions in free cash flow.
Okay, so Netflix makes money, others lose it. What's the impact of that difference?
It forces those rivals to pull back. They have to cut their content spending. And this is really striking. Highlighted in the analysis, some competitors are now actually licensing their own valuable shows to Netflix.
To generate cash.
Exactly. To generate much-needed revenue. The analysis sees this as a powerful sign of Netflix's dominant market position. It creates a widening competitive gap.
So Netflix is the only one really making significant profit in streaming video.
According to this source, yes. The only significantly profitable cash-generating SVOD business at scale.
Is there any quantitative data backing up this widening idea? You mentioned something that caught my eye earlier.
Yeah. The corporate demand share metric. It measures the total audience demand for a company's original TV shows across the whole industry.
Okay.
What's amazing is that in 2024, Netflix, which really only started making originals seriously around 2012, actually surpassed the demand share of NBC Universal.
A studio that's been around since the 1940s.
Right. And even more critically, the analysis points out Netflix was the only major media company to actually grow its demand share in 2024. Everyone else, including Disney, saw theirs decline.
That does seem pretty unambiguous.
Yeah, unambiguous evidence those fortress walls are getting higher, not shrinking.
But then there's the global data advantage layer.
Right. Operating in 190-plus countries gives them this incredible fire hose of viewership data across so many different cultures. The analysis mentions they analyzed something like 2,000 different global taste clusters.
Taste clusters, how does that help the Moat?
It's a huge content strategy advantage. It lets them spot a local hit, say La Casa de Papel from Spain or Squid Game from Korea, and see from the data patterns that it has the potential to break out globally.
Ah, so they can make smarter bets.
Exactly. Make smarter, more efficient content investments. Greenlight a show in one country, knowing there's a good chance it finds a huge audience elsewhere, maximizing the ROI. This global data feedback loop makes their content flywheel spin faster and more efficiently than, purely regional competitors can manage.
Okay, so we've got the business, the evolution, the Moat. The analysis also includes some insights from a simulated Scuttlebutt, digging into customer feelings and employee culture. Let's look behind that curtain. What's the customer vibe?
Overwhelmingly positive, according to the analysis. Though, not perfect. People love the huge library, the quality of the originals, the user interface, often called the best in the industry. And for many, the commercial-free experience on the main tiers.
Are there numbers to back that positive sentiment up?
Yeah, a 2024 survey cited shows 82% were extremely or very satisfied. They ranked number one for original content satisfaction at 81% and UI at 75%. Their Net Promoter Score, NPS, is mentioned as a healthy plus 43.
Which translates to loyalty.
Apparently so. 93% of customers are still subscribed after 2 years or more. That's incredibly sticky.
What about the downsides? What are the common frustrations mentioned?
The usual things, really. Rising prices are mentioned, licensed content disappearing sometimes, minor UI annoyances like auto-playing trailers.
But the low churn suggests...
Yeah, the low churn is the key takeaway. Despite those grumbles, the perceived value clearly justifies the cost for most people.
Okay, now the employee culture sounds different. The analysis uses the term intensely polarized.
Yeah, that's the phrase. It reflects that famously demanding culture, often summed up by Reed Hastings' Keeper test.
The Keeper test.
Where managers are basically asked, if an employee was thinking of leaving, would you fight hard to keep them? If the answer is no, that person probably isn't long for Netflix. It's intense.
So what's the positive spin on that culture?
Well, the analysis notes that people who thrive there really praise the top-of-market pay, working with exceptionally smart colleagues, the transparency, and a lot of professional freedom. Comparably, reviews are cited as 89% positive. For the right fit, it's described as, the best job ever.
And the flip side, the criticisms.
A recurring theme is a culture of fear, high turnover, feeling like you're an expendable asset if your performance dips even slightly. Poor work-life balance is mentioned. Managers being seen as actively weeding out non-A players.
How does the analysis connect this, tough internal culture to the positive customer experience? It seems like a paradox.
The analysis frames it as a double-edged sword, but one that's actually integral to their success.
How so?
This culture attracts and retains absolutely elite performers. And this concentration of top talent is credited with driving their execution and innovation, building the best UI, the sophisticated algorithms, consistently greenlighting hits. So while it definitely creates burnout risk and isn't for everyone, that whole professional sports team, not a family philosophy, focusing on A players, quick replacement. Yeah, it's highlighted as a key mechanism.
So the fear is linked to the love.
In a way, yeah. The analysis argues that the culture of fear, reported by some, is kind of the flip side of the customer love coin. That intense internal focus on peak performance is what enables them to produce the superior product that leads to that industry best satisfaction and retention.
Let's shift to the leadership steering the ship in the financial results. How's the management situation described?
It's seen as a thoughtful evolution. Reed Hastings, the founder, is now chairman. The company is led by co-CEOs, Ted Sarandos handling the creative content side, and Greg Peters focused on ops and tech.
Complementary skills.
Exactly. The analysis highlights that and says they present a really unified front. Like speaking to one is effectively speaking to both on strategy.
And their core philosophy for running the business.
Deliver more joy to our members is apparently their North Star. Engagement metrics are everything because they tie directly to satisfaction, retention, value. But there's also a very clear shift noted towards prioritizing profitable growth. They're targeting, what was it, a 24% operating margin for fiscal 2024.
Right.
So the analysis sees this blend, long-term vision content, international ads, gaming, but also real adaptability. That password ad tier pivot is the key example. It shows a non-dogmatic, owner-oriented mindset.
What about how they use their money? Capital allocation.
Described as disciplined and very shareholder-friendly.
Yeah.
Priority 1 is clearly reinvesting in the core business, mostly content. That's the big $17 billion annual number.
And they measure the return on that.
Yeah, the analysis notes it's evaluated rigorously based on engagement, cost per hour watched, things like that. Focus is heavily on originals.
Have they done big acquisitions like some other media companies?
No, and that's highlighted as a major positive. They've avoided large, potentially value-destroying M&A deals, mostly just small tuck-in acquisitions of gaming studios. Effectively zero net spend on M&A in 2023-2024, according to the source.
Rational.
Yeah, rational avoidance of empire building, as the analysis puts it.
And returning cash to shareholders.
No dividend, but a strong commitment to share buybacks. Another $10 billion was authorized in late 2023, and they bought back, I think, $3.5 billion in Q1 2025 alone. So yeah, reliably returning excess cash.
Okay, let's look at the financial fortress itself. The analysis calls Netflix a reliable, scalable earnings machine. What are the key numbers showing that?
This is where you really see the business transformation in black and white. Operating income has grown incredibly consistently from about $4.6 billion in 2020 to over $11 billion on a trailing 12-month basis now.
And net income?
Similar story, from $2.76 billion in 2020 to over $9 billion TTM. Just powerful, steady earnings growth at massive scale.
The analysis highlights a few key quality ratios that tell this story powerfully. Which ones?
3 really critical ones. First, ROIC, return on invested capital. This metric has shot up, now sitting at 22.2% TTM.
Which is good.
Very good. A company consistently hitting over 15-20% ROIC demonstrates a truly superior business with a durable edge. The recent surge shows their profitability at scale is really kicking in. It means for every dollar they reinvest, they're getting over 22 cents back in operating profit after tax. Super efficient.
Okay, strong returns on investment. What about cash flow? That used to be a criticism.
Exactly. Free cash flow was often negative because of the huge upfront content costs. But the analysis shows a massive inflection point. In 2023, they generated $6.93 billion in free cash flow from only $5.41 billion in net income.
More cash than profit.
Yeah, over 128% conversion. The analysis flat out calls them a true cash machine now, generating way more cash than their accounting profit suggests.
That's a huge turnaround. And the balance sheet, debt levels.
Exceptionally strong, de-risked. Their net debt to EBITDA ratio is down to just 0.3x TTM. The analysis calls it a huge margin of safety. It used to be over 1.0x, so it's come down significantly.
So putting those three together, rising ROIC, gushing free cash flow, falling debt, what's the big picture takeaway from the analysis?
That simultaneous improvement across all three is presented as the ultimate quantitative proof of the moat's power and the business's transformation. It just demolishes those old bear arguments about negative cash flow and too much debt. Their predictable subscription revenue now easily covers cash needs. The high and rising ROIC shows their investments are paying off handsomely. And the FCF proves it. The analysis basically concludes, This financial fortress is the direct result of the competitive fortress they've built.
All right, so the analysis paints this picture of a, frankly, remarkably high-quality business, but we always say a great company isn't automatically a great investment if the price is too high. What does the analysis conclude about the current price versus the underlying value?
Yeah, the clear message is that it's a demanding entry point right now.
Meaning expensive.
Pretty much. Looking at metrics like the trailing PE ratio, it's around 57x. That's compared to its own 5-year average of about 50x. So trading at a premium even to its recent history.
What about price to free cash flow?
That's even higher, around 71x PTM. Though, as the analysis notes, that's maybe less comparable historically because the strong positive FCF is relatively recent.
So the market gets it. The market sees the quality we've been talking about.
Precisely. The analysis states the market is well aware of the quality and is pricing in pretty significant expectations for future growth. At these levels, they're seen as very little margin of safety.
So investing now requires confidence.
A high degree of confidence in near-flawless execution going forward, yeah. This assessment seems to align with others, like Morningstar, who apparently rate the stock as overvalued. It's priced for something close to perfection.
Where does the analysis see the main growth coming from to justify that price?
The primary engine identified is successfully scaling up the advertising business. That's seen as the biggest opportunity.
How big?
It's viewed as this vast, mostly untapped pool of revenue. Projections mentioned suggest it could be a $10 billion annual revenue opportunity by 2030. And crucially, it's high incremental margin revenue.
Meaning most of it drops to the bottom line.
Exactly. Driving margin expansion. Secondary drivers are, continued international subscriber growth and maybe some future price increases, leveraging that pricing power.
Okay, but what could go wrong? What are the big risks identified that could permanently damage the business or its story?
3 main ones are highlighted. First, just intensifying competition and the risk that streaming becomes more commoditized.
Like a utility.
Yeah. Even with Netflix's Moat, you've still got Apple, Amazon, Disney investing heavily. The risk is services become interchangeable. People just jump around for specific shows, hurting Netflix's value prop and pricing power.
Makes sense. What else?
Second, the failure of the content engine. The whole business rests on consistently producing hits. Content is notoriously unpredictable.
Right.
A long creative dry spell could really damage the brand, push churn up, kill that pricing power, and shrink the moat.
And the third risk?
Technological disruption. Netflix disrupted linear TV, right?
Yeah.
But it could get disrupted itself. The analysis mentions things like maybe AI storytelling or major shifts in AR/VR changing how we consume stories. If Netflix is slow to adapt to something like that, it could lose its lead.
Okay, so we have the strong bull case, the moat, the financials, but also these risks and the high valuation. The analysis wraps up with something called a red team challenge. Can you explain what that is?
Yeah, it's basically a structured exercise where you intentionally try to poke holes in your own bullish arguments. You invoke the bull case
To find the flaws.
to find the most compelling reason why investing today, even knowing all the positives, might still be a mistake. What's the strongest bear case?
So what core assumptions does this red team challenge attack for Netflix?
It goes right after the 2 pillars. The assumption that Netflix will keep its super low churn and strong pricing power indefinitely, and the assumption that the advertising business will scale up into that huge high-margin success story.
Okay, so what's the nightmare scenario it paints? The inverted picture.
The red team scenario imagines the streaming wars don't end nicely with Netflix dominating. Instead, they devolve into this permanent, ugly war of attrition.
Ow.
Because there's just a constant flood of good enough substitute content from rivals. The value of exclusive content diminishes because there's always something else compelling to watch on another service.
And how would that change how people behave?
Customers become promiscuous. That's the term used. Instead of sticking around, they binge Bridgerton on Netflix, cancel, jump to Disney Plus for the latest Marvel thing, cancel, then hop over to Max for House of the Dragon. Constant churning.
Okay, I see. So in that world,
The low churn evaporates.
Yeah.
Pricing power vanishes because why pay more when good alternatives are cheap and easy to switch to? Price hikes trigger mass cancellations.
and the big advertising dream.
It turns out to be a mirage, or much smaller. The market is saturated. Advertisers have all the power. They refuse to pay premium rates for Netflix ads, treating it like just another commodity video source. That high-margin revenue disappoints, margin expansion stalls.
So what's the end game for Netflix in that bleak scenario?
Gets caught in a trap. It has to keep spending tens of billions a year on content just to stay in the game, just to keep people's attention for a little while.
But it can't fund it.
Not easily. It can't raise prices effectively. And the ad business isn't the cash cow everyone expected. So its ROIC stagnates or maybe even declines because the content spend isn't efficient anymore. Free cash flow massively disappoints those high expectations baked into the current stock price.
And the final outcome for the stock?
The market fundamentally re-rates Netflix. It stops seeing it as this high-growth, tech-like winner and starts viewing it as just another mature, low-growth, capital-hungry legacy media company stuck in a brutal commodity fight. Yeah. The valuation multiple collapses from today's 50x plus earnings. An investment made now, priced for perfection, could lead to permanent capital loss or, as the analysis puts it rather grimly, a decade of dead money.
Wow, okay. That red team challenge definitely provides a sobering counterpoint after hearing about all the strengths. We have covered a lot of ground in this deep dive, from that simple core business model through its really fascinating evolution
to the building and apparently widening of that powerful competitive moat.
The incredible turnaround in the financials, becoming a cash machine.
But then also a very clear-eyed look at the significant risks and that demanding valuation.
Yeah. It seems undeniable from this analysis that Netflix has built something truly exceptional, a really formidable business.
Yeah, unique scale, great content engine, this potentially huge second growth driver in ads. But the analysis is just as clear about the steep price the market is asking for that quality right now, and the very real hurdles and risks that lie ahead.
It really hammers home that core investing principle, doesn't it? The quality of the business is one thing, but the price you pay for that quality is always paramount for you, the listener, thinking through this analysis.
Absolutely. And maybe that leaves us with one final provocative thought pulled straight from that red team challenge in the analysis. Could the market today be underestimating the risk that this whole streaming landscape doesn't consolidate nicely into a winner-take-most scenario? What if it actually devolves into more of a persistent commodity war? That would fundamentally change Netflix's future story from the high-growth, high-margin narrative that seems baked into the stock price right now. Definitely something to mull over as you process everything we've dug into in this deep dive.